West Texas crude oil rallied by 25% as we are speaking right now in today's Asia session, a tremendous gap up as there's no signs of de-escalation between the US-Iran war as it continues to head into the 10th day. Risk off is being seen in the major global stock indices today, where the S&P 500 E-mini futures and the Nasdaq 100 E-mini futures both tumbled by close to 2%. The oil importers South Korea, Kospi 200, and as well as the Nikkei 225 continues to plummet, where the Japanese 225 is down by almost negative 7% as we are speaking. And also in the FX market, broad-based strength is being seen in the US dollar, with the exception of the Canadian dollar that managed to inch slightly higher by 0.07% due to its high sensitivity to higher oil prices, and gold continues to trap within a range due to two conflicting factors. Higher geopolitical risk premium, on the other hand, is being offset by a rise in the long-term US 10-year Treasury real yield, making gold opportunity cost being higher due to the risk of a stagflationary environment. Hi, welcome back to all in today's volatile session. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. Today will be the Monday, the 9th of March 2026. So before we uncover today's key intraday technical outlook, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right. Okay, so as usual, let's have a quick start. Recap what has taken shape in terms of the news flow, economic data release, and the current price section. So today's key important price action will be centered on oil prices. That is the main driver that is driving the broad-based cross-asset movement, at least in the near-term basis over here. So let me share with you my screen. Okay, so hopefully everything is good. All right, great, excellent. So what you could see over here is that the West Texas crude oil, as we are speaking right now, increased to almost 25%, 23.54 as we are speaking, hit a intraday high of 119.54. All right, over here, and that's that's $100 per barrel, and this is the first time oil prices trading $100 per barrel since August 2022, and based on the current price action right now, it's actually trading close to a 6-year high as well at 112.44. So this tremendous gap up in oil price within the last 3 hours as we are speaking, up by 21%, maximum 25% so far at 11:09 a.m. Singapore time, was due to this ongoing escalation between US and Iran that is showing no sign of de-escalation over here. And right now, there's actually more tit for tat measures, rhetoric attacks from both sides, where US now tell their embassy staff to actually leave the US embassy, tell their US, we call it American employees, diplomats in Saudi Arabia to leave the country, citing safety risks. And this move marks the US State Department agency first approved order departure since the Iran conflict started on February 28th, all right, which was last Saturday. So with this, orders that's being made by the U.S. State Department asking American employees and diplomats to leave Saudi Arabia, this represents a stark, turn in the event, stating that there is no signs of de-escalation in this ongoing US-Iran conflict, and market participant now continues to actually play the safe haven narrative, is to sell away whatever weakness that was seen at the start of this year, risk asset, and also gold being the winner last year is being trapped in a range as well. So as we're speaking right now, gold is down by negative 1.7%, but still holding above that key short-term pivotal support that we highlighted last week at 5,065 over here. So one of the reasons why gold could not rally so strongly as you are speaking right now is due to that stagflation risk over here. So let me explain to you what is this stagflation risk. So this stagflation risk is being taken into account of higher inflationary expectation. So let me share with you this chart of the intermarket analysis of gold over here. All right, so this is the chart of gold, and this is the US 10-year real yield. All right, so basically this is the US 10-year yield minus off the 10-year inflationary expectation as given by the 10-year US break-even rates over here. So we know that ever since this we call it 10-year US Treasury yield has been trading inside this major broad-based descending channel since the 23rd of October 2023 high. It has led to a strong rally in gold as well. And recently, gold price can't break above its closing price on 2nd of March, which is at 5,322 over here. You could see on my screen 5,322 and inches downward. All right, and this push down in gold price since 2nd of March 2026 over here. Let me put it in the group arrow, right, in red arrow. Okay, so this fall in gold is due to a correspondent bounce in the 10-year US Treasury yield. All right, over here. So the 10-year US Treasury real yield has an indirect correlation with gold. So make it think this as over here is that interest rate that pays you if you invest in 10-year US Treasury bond. All right, over here. So given the fact that if gold itself is a non-income interest-bearing asset, so if this US 10-year Treasury bond give you a higher yield, a real yield at 1.84%, where it bounces from 1.66% since hitting the low of 3rd of March. And that is the key, we call it medium-term range support level that has been in place since 17th of September / 23rd of October 2025. So given this recent bounce in the 10-year US Treasury yield, that actually increases the cost of holding gold, opportunity cost of holding gold, given that gold is a non-interest income bearing asset. So that's why gold price can't manage to seek fresh all-time high so far amid the ongoing geopolitical risk premium that is coming out from the Middle East, because that actually created a trigger in oil prices as well, which increases inflationary expectation. In the end of the day, increases the 10-year US Treasury real yield, given that the 10-year US Treasury real yield is being derived from the 10-year Treasury nominal yield minus of the inflationary expectation over here. All right, so it causes the bounce as well. All right, in the 10-year US Treasury real yield, given the fact that there's a risk of opportunity cost getting higher due to higher inflationary expectation, in the end creating a lackluster movement in gold price. All right, so that actually explain the why gold price can't rise due to this intermarket analysis between the 10-year US Treasury real yield and the spot gold XAU/USD. Then over to the FX market over here. So this is the 5-day rolling performance of the US dollar against other major currency together with the Euro Swiss as of 8th of March we are speaking right now. So what I could see over here is that we start to see a K-shaped performance where dollar is strengthening against almost all the other currency, including the dollar Aussie, the dollar Euro, the dollar Kiwi, the dollar Sterling, the dollar Yen, the dollar we call it the Sing dollar, the dollar Swiss franc, the dollar CNH, which is the China offshore yen, but the dollar didn't strengthen that much against the dollar CAD, which is based on a 5-day rolling performance, is down by negative 0.8%, and also the Euro Swiss is down by negative 1.10%. So the Euro Swiss is also being used as a risk-off, risk-on proxy. So if it starts to see a risk-off environment in the global stock market, the Euro Swiss will tend to tumble as well. So if you look at the 1-day rolling performance, taking into account of the last 24 hours, the dollar CAD is the weakest one right now, down by negative 0.21%. We see a bit of recovery in the Aussie dollar, where the dollar Aussie is actually trading down by negative 0.08% over here. All right, so net overall, the dollar strength is strengthening. So how do we know that? If we were to look at the US dollar index, so the US dollar index continues to bounce above the 200-day moving average based on last Friday price action, and also managed to bounce based on this former descending resistance from the high of 24th of November last year, now turns into a pullback support, and potentially right now is enrolled into this so-called key medium-term range resistance that has been in place since 29th of May last year, 2025, at 100.10 and 100.53 over here. So in terms of a very short-term basis, the dollar strength on the average still shows signs of a potential rally, despite the fact that on last Friday we have a weaker labor market coming out from that lackluster non-farm payroll data. So let's take a look at the non-farm payroll data. So on last Friday, the non-farm payroll data show signs of a US labor weakness. So market is expecting 59K jobs added, but it only came in with a loss of negative 92K jobs over here. And with the loss of 92K jobs, I think this is the first time for a couple of years that it fared worse than expected over here. All right. So this is the worst since October 2025. All right. Over here we show 140K jobs lost. And most startlingly, if you look at the unemployment rate over here, so oops, what happened? Let me go back. Okay, let me go back over here. Yeah, the unemployment rate. So the unemployment rate inch higher to 4.4%, right? So that is close to last November print of a 4-year high at 4.5%. So overall, if you look at the 10-year trend, the unemployment rate has started to slowly pick up over here, which cemented that the US labor market has turned weaker. So despite the fact that the US labor market has turned weaker, we should be seeing the US Federal Reserve be much more gung-ho in cutting rates. But however, due to the rise in the oil price, potentially their hands may be tied for this year in cutting rates because of stagflation risk. So that actually explains to us why the US dollar is strengthening almost against all major currency except for the Canada dollar, and also explain to us why we now start to see a risk-off environment in the global stock market due to a potentially global tightening of liquidity if the Fed will pause its interest rate cut cycle this year. So if you look at the CME Fed Watch 2 at this juncture, let me refresh the CME Fed Watch 2, which tell us what is the probability or odds of an interest rate cut, hike or hold based on the price action of the Fed Funds futures traders behavior. So if you look at the aggregated tab over here, currently the Fed funds rate is at 3.5% to 3.375% after 3 interest rate cuts last year, where the Fed kickstart its interest rate cut cycle in late 2025. So market is looking for no change at all for the upcoming next 18th of March 2026 meeting. Very high chance of 95%, and also a high chance to stamp pad again on the 29th of April meeting 2026 at 81% chance, and almost a coin flip of 56% chance that the Fed will introduce the 4th cut on 17th of June 2026 meeting. but however, a higher chance on the 29th of July meeting or on the 16th of September 2026 meeting. So now market participant is expecting the Fed to only kickstart somewhere around the late summer months and even the autumn months of this year to bring the Fed funds rate down to 3.25% to 3.5%. But market is still looking for a high chance that the Fed will introduce another, we call it a second cut for this year, bringing the total cuts of 5 interest rate cuts since the interest rate cut cycle kick-started late last year. 85% chance on 28th of October and 72% chance on the 9th of December, the last meeting of this year, to bring the Fed funds rate lower to 3% to 3.25%. So overall, market participants is still pricing in 2 interest rate cuts at least before 2026 ends. But this probability will change, especially the potential, we call it the fifth cut for this year may even be back to the probability may be lesser than 50% if oil prices continues to rise higher to about $130 per barrel. That is breaking above the March 2022 peak that is being seen during the onset of the Russia-Ukraine war at that point in time, where the West Texas crude oil hit $130 per barrel at that point in time. So let us touch more about the intraday technical outlook. All right, so now that covers the first segment of the daily dose. Now let me move on to the second segment, which is the intraday technical outlook on all the broad-based cross asset classes. So with that, let me expand my screen. Okay, so let us start with the FX market. Okay, starting with the euro dollar. Okay, I think the screen is good. All right. Okay, so this is the euro dollar. So the euro dollar broke down below our first support level at 156.65 over here, and now continues to trade lower, hitting very close to the 149.95, 114.95, 114.70 level, which is the 1.382 Fibo extension in this ongoing corrective decline since the high of 28th of January. So no change. We will be still maintaining our bearish bias on the euro dollar using a slightly tightened short-term pivotal resistance for today, which was this former minor range support level from the low of 3rd of March and 6th of March, got broken down today in today's gap down session. Asia session, that will be at 115.65. So using a tightened pivotal resistance at 115.65 for today to maintain this ongoing bearish bias on the euro dollar for it to see further potential weakness, with the first intermediate support zone coming in at 114.95/114.70. Breaking down below 114.70 will potentially expose the next psychological level at 114 figure level, which is close to the 1.618 Fibo extension of this ongoing corrective decline from the high of 28th of January. And if you go back in time, that was also the minor swing low area of 31st of July and 1st of August last year. Only a bullish breakout and the hourly close above 115.65 that would negate today's bearish tone to see a squeeze up to revisit last Friday US session high at 116.20. Breaking above 116.20 may see further squeeze up to retest the 200-day moving average, now acting as the next intermediate resistance level as well, confluencing it at 116.73. All right, so that's for the euro dollar, maintaining our intraday bearish bias with a tightened short-term pivotal resistance at 115.65 today. Next up will be the sterling pound. So the sterling pound did a bearish reaction exactly at the 133.72, 134.04 short-term pivotal resistance zone that we highlighted on Friday. Broke down below this minor swing low at this 133.14 level over here. So right now it's actually testing the swing low area of 3rd of March, which is 132.65. So still maintaining that bearish bias, no change in the key levels. So unless we see a bearish breakdown below 132.65, the hourly close below it, then I will tighten my pivotal resistance for today at 133.14, 133.14. Below 132.65 exposes 133.20, which is the lower limit of this ongoing medium-term descending channel from the high of 28th of January. Breaking below 132.20 may see further weakness to expose the next intermediate support zone at 131.55. 131.25, which is the 1.618 Fibo extension on this ongoing corrective decline from the high of 28th of January. And if you go back over here, which will be the congestion area of 19th of November and the minor swing low of 26th of November last year. Right, so that's for the sterling dollar. Next will be the Aussie dollar over here. So the Aussie dollar is trading down by negative 0.52%, given the fact that the Aussie dollar also can't shade off the weakness that is being inflicted on it due to the fact that it's still considered as a commodity currency, because there is one element that is being embedded in the Aussie is either than being a commodity currency, is also being reflected as a risk on, risk off proxy as well. So if we start to see a risk of significant movement in the global stock indices, the Aussie dollar will tend to trade in tandem with the risk off environment that is being seen in the global indices. So what we could see now, the Aussie dollar, is that if you were to look at the current RSI, is being kept by a parallel descending trendline resistance right below the 50 level mark. And right now, we now start to see a minor descending channel that starts to form since the minor swing high of 27th of February. So with that, I will flip to a bearish bias stance for today, using last Friday US session high over here during the start of the US session, which is at 670.30. So using 70.30 as my short-term pivotal resistance level, we will flip to a intraday bearish bias stance on the Aussie dollar for it to revisit the 69.10, 68.90 medium-term pivotal support level, which is also the lower limit of this minor descending channel, and as well converging with the rising 50-day moving average. So first support level to watch 6944, followed by 6910, 6890 for today. Only a bullish breakout above 70.30 that would negate the bearish tone. I repeat again, only a bullish breakout above 70.30 and the hourly close above the short-term pivotal resistance level will negate the bearish tone on the Aussie dollar to see a squeeze up to revisit the 20-day moving average again, and as well as the minor descending channel resistance as well, converging at 70.70. So that will be 0.7070. Okay, slash 70.88 over here. So 70.70 slash 70.88. Right, so flipping to a mild bearish bias stance on the Aussie dollar for today, for using 70.30 as my short-term pivotal resistance due to the fact that it seems to be trading in line with the risk-off environment that's being seen in the major global stock indices, rather than behaving like a commodities currency. All right, next will be the dollar yen. All right, so dollar yen last Friday we were neutral, so it broke above our neutrality range at around 157.90 level, and now is en route towards 158.90, 159.45, which is the swing high of 14th of Jan. Before that, a risk of intervention took shape, where there is this market participants, we call it at that point in time, fearing that there could be a joint intervention from US and Japan to top down the dollar yen. All right, so with that, we will now have a rather tight short-term pivotal support level for today. So far, the bullish momentum still remains intact. RSI is at the overbought level, but however, there's no bearish divergence that's being fleshed out. So there could be a chance of only a minor pullback before the price action resumes its ascent upwards. So using a tight short-term pivotal support level for today, using a tight short-term pivotal support for today, which is the former minor swing high of 3rd of March, and on last Friday US session, before today's Asia session gap up, now turns into a critical pullback support level in today's session, 158 figure level, a tight short-term pivotal support level. Flip to a intraday bullish bias stance on the dollar yen above 158.90, potentially take us up to the key swing high area of 14th of Jan 2026 at 149.45. Breaking above it may seek out 160.23 next. All right, over here. So 160.23, if you go back in time on the daily time frame, this is also the previous time where on the 29th of April 2024 and as well as 8th of July 2024, where there is also an intervention that has taken shape by the Ministry of Finance in Japan to actually sell down the dollar yen previously, all right, over here. So that is the levels on the dollar yen on the intraday basis on the upside if price action continues to get higher. However, a breakdown below 158 figure level, that is our short-term pivotal support level, that will invalidate today's intraday bullish bias to see another round of choppy decline unfolding. In first step, 15740, which was last Friday US session low, breaking below 157.40, open up scope for more intraday weakness towards 15645/17, which is the minor swing low of 5th of March and the congestion area here of 27th of February and 2nd of March, and so confluencing with the 50-day moving average. So that's for the dollar yen, flipping to a intraday bullish bias using a rather tight pivotal support at 158 figure level. Right, so that sum up all the 4 major US dollar pair. Let us now proceed with the major stock indices, starting with the Hong Kong 33. Okay, so the Hong Kong 33 in today's Asia session, it gapped down but managed to survive at our pivotal long-term pivotal support that we highlighted last Friday, 24,765 over here. So with the rest of the other major global stock indices trading in a bearish bias tone, I will be not so convinced of a recovery in the Hong Kong 33 for today, which represent the Hang Seng Index. So hence, I'll be flipping to a intraday neutrality stance between the gap resistance that it gap down today, the upper limit at 25,262, and using the long-term pivotal support of 24,765 as my lower neutrality range for today. So flipping to a neutrality stance between 25,262 and 24,765 for today. However, if we start to see a bearish breakdown below 24,765, then potentially with an hourly close below it, we may invite further intraday weakness on the Hong Kong 33 to open up scope towards the next support level at 24,257, which is the minor swing low of 1st of August last year. All right, so that's for the Hong Kong 33 representing the Hang Seng Index. Next up will be the Japan 225 that represent the Nikkei 225. So Japan 225 broke below the former major ascending channel support from the low of 7th of April 2025 and also broke below our medium-term pivotal support zone that we highlighted on last Friday, where initially we expect a bounce to take shape, at least to retest 55,760. In today's session, it gapped down, so we got to respect the fact that the recovery scenario, the earlier anticipated minor recovery scenario has been invalidated, and there could be further weakness ahead over here after this minor pullback has taken shape, given the fact that the RSI now has started to exit from the overbought area. So why is exit from the overbought layer? There is no bullish divergence as price action trade in the lower low as well. So using a rather tight short-term pivotal resistance for today, 53,066 slash 53,616 over here, that will be my short-term pivotal resistance zone, which is so very close to the gap down that's being seen in today's Asia session. Flip to a bearish bias stance for the Japan 225 below 51,055, which is today's current intraday low at 11:33 a.m. we are speaking right now, and also the minor swing low of 8th of January previously may expose the next intermediate support level at 50,160, followed by 48,835, which is the one-time Fibo extension and the 1.236 Fibo extension taken from this corrective decline that is still intact since 26th of February 2026 all-time high. And going back in time, that also corresponds with the graphical swing low area of 22nd of December and 31st of December for 50,160 and 48,835 coincide with the swing low of 18th of December last year. Only a bullish breakout above 53,616 that would invalidate today's bearish bias view to see a squeeze up towards 54,606, which is right exactly at the 50-day moving average again. Above 54,606 will see a steeper counter trend rally to retest last Friday Asia session high at 55,760. All right, so that's for the Japan 225. Next will be the Germany 30, the German DAX. So the German DAX plummeted as expected and broke below our support area at 23,146, 23,070, which is today's Asia sessions high. So using the former support now turns into a critical short-term pivotal resistance level at 23,070, 23,146. Continue to maintain our bearish bias stance over here in any form of any bounce. Next support level to watch after breaking below 22,687, which is today's intraday Asia session low as we are speaking 11:35 a.m. Singapore time, may expose the next near-term support level at 22,312, 21,948, 21,846 next, which is the minor swing low area. If you go back in time of 29th of April and 2nd of May 2025 last year, and the swing low area of 24th of April and 23rd of April last year, and that also coincide with the 2.618 Fibo extension of this ongoing corrective decline taken from the current all-time high of 13th of January this year. Only a bullish breakout and the hourly close above 23,046 that would invalidate today's bearish bias view to see a minor counter trend rally to retest 23,388. Above 23,388 we'll see a steeper minor counter trend rally to revisit last Friday US session high. We'll revisit last Friday US session high at 23,710, which is the former range support level of 4th of March, and 6th of March now turns into a pullback resistance as well. So that's 23,710. All right, next will be the US Wall Street 30. That's representing the Dow Jones Industrial Average. So price action also gap down, hitting our support level and plummet lower. And right now is testing the long-term pivotal support level at 46,330 over here. So 46,330 also confluence very closely with the 200-day moving average. So given there's no signs of a recovery, significant recovery, so what we do is that I will have a rather tight short-term pivotal resistance for today on the US Wall Street 30. That's representing the Dow Jones Industrial Average, which is today's Asia session high, after the gap down at 46,870 as we are speaking at 11:37 a.m. Singapore time. So using 46,870 short-term pivotal resistance level, maintaining our bearish bias view on the US Wall Street 30, breaking down below 46,330 may expose further weakness towards 45,780, 45,485, and even 45,190/45,126, which is the 2.618 Fibo extension of this ongoing decline taken from the current all-time high of 10th of February, close to the 50,004 at the 50,530 level over here. All right, so if we were to see a squeeze up above 46,870 and the hourly close above it, today's bearish bias view will be invalidated to see kickstart a minor counter trend rebound scenario, covering up the gap resistance level at 47,270/47,350, which was the last Friday US session high. Above 47,350, we'll see a steeper minor counter trend rebound towards 47,736, 47,860, which is the former minor swing low area of 3rd of March and 6th of March, and also the former medium-term ascending channel support from the low of 23rd of May last year now turns into a pullback resistance at around 47,860 as well over here. All right, so that's for the US Wall Street 30. Next will be the SPX 500 over here. So the SPX 500 right now has broken down below the 200-day moving average. Now it's doing a retest it at 600 and 610, 600, 610, 6610 over here. All right, so with that, we'll still maintain a bearish bias view on the SPX 500 using a tightened short-term pivotal resistance for today, which is today's Asia session high after the gap down at 6,664. Using tightened short-term pivotal resistance 6,664, maintain that bearish bias view. Next support level to watch 6,535/6,500, followed by 6,447, 6,426, which is the 0.618 Fibo extension on this ongoing decline, since the we call it a high of 28th of January, which is the current all-time high at 28th of January at around the 7,000 mark over here, and the exact high is 7,020. And the 6,447, 6,426 is the 2 times FIBO extension of this ongoing corrective decline, also taken from the high of 20th of January. And graphically, if you go back in time, it's the minor swing low area of 21st of November last year, the minor swing low area of 13th of October last year for 6,535, 6,500, and the lower support of 6,447, 6,426 is the minor congestion area of 3rd of September and 5th of September last year. All right, only a bullish breakout and an hourly close above 6,664 that would invalidate today's direct bearish bias view to kickstart a minor mean reversion counter trend rally to cover the gap, which was the former medium-term support level at 6,733, 6,720. That's for the SPX 500, maintaining a bearish bias view with a tightened short-term pivotal resistance for today at 6,664. Next up will be the Nasdaq 100. So the Nasdaq also broke down as expected, now breaking below the 200-day moving average, and also breaking below our former medium-term pivotal support level at 24,140. So using a tightened short-term pivotal resistance for today as well on the Nasdaq 100, which is today's Asia session high on the gap down at 24,340. So 24,340, tightened short-term pivotal resistance, maintain that bearish bias view. Next support level to watch, 23,955, 23,840, which is the 0.764 pivot extension of this ongoing corrective decline from 28th of January high. Breaking below 23,840 may expose the one-time FIBO extension, also taken from the high of 28th of January, towards the next intermediate support zone at 23,506, 23,400 level. So 23,506, 23,400 level is also graphically, if you go back in time, is the minor congestion area of 4th of September and 5th of September last year. Only a bullish breakout above 24,350, pardon me. So only a bullish breakout above 24,350, tightened short-term pivotal resistance level that would invalidate today's bearish bias view to see a counter trend rebound, a squeeze up towards the gap resistance level at 24,547. Breaking above 24,547 will see a steeper minor counter trend rally to retest the 20-day moving average, which is also confluencing at 24,890 next, which is the minor swing high area of last Friday US session. All right, so that's for the Nasdaq 100, maintaining a bearish bias view with a tightened short-term pivotal resistance at 24,350. Right, next up will be the commodities market, starting with Gold XAU/USD. So Gold XAU/USD continues to bounce at the 5,046 short-term pivotal support level that we highlighted. No hourly close below it in today's opening Asia session. So, and also a bounce off from the pivotal, bounce off from the lower limit of this minor ascending channel support from the low of 6th of February. That is still intact, and also now bouncing very closely to the 20-day moving average as well. So no change, still maintain a mild bullish bias given that gold is being trapped by conflicting factors. So two resistance level to watch will be today will be 5,192, where last Friday US price action almost hitting a high of 5,000. Give me a minute now, 5,176. So clearance above 5,192 may potentially see a further push up towards 5,280. So only a clearance above 5,280 will allow the bulls to gain more traction to test the 30th of January 2000 minor swing high at this 5,448 as well over here. Right, 5,448. However, if you start to see a bearish breakdown and the hourly close below 5,046, then today's mild bullish bias view will be invalidated to see a continuation of this corrective decline sequence unfolding towards 4,960, followed by 4,842, which confluence with the rising 50-day moving average. All right, so still maintaining the mild bullish bias on gold using 5,046 short-term pivotal support that managed to survive in today's Asia session at 9 AM Singapore time. Right, next will be the red hot West Texas crude oil over here. So the West Texas oil gap up and cleared above all our resistance level that we highlighted previously. So what we could see now is en route towards a key milestone area at 8/June/14 June 2022 high, and the all important 130.30, which is the 7th of March 2022 swing high. That is the high that is being seen during the onset of the Russia-Ukraine war at the point in time. And if you take into a FIBO extension level, that also confirms with 4.236 very closely at 132.67, taken from this ongoing impulsive upward sequence that has been intact since the low of 26th of February 2026. So we'll still maintain a bullish bias view in any minor pullback using a tightened short-term pivotal support level for today at 102.25, which is also today's Asia session low after the initial gap up that is being seen, towards 124.40, followed by 130.30, 132.67 potentially in today's intraday session. Only a bearish breakdown and an hourly close below 102.25 that will transform into a much more deeper minor corrective pullback sequence for it to retrace down towards the get up support level that is being seen at 92.47. I put in writing 92.47, followed by 86.11. Okay, which is the pullback line of this former minor ascending channel resistance now turns into a pullback support level. And if you do the FIBO retracement of the last minor impulsive up move, sorry, from here, the last 26th of February, all the way up to the current high, that also coincide with the golden ratio of 61.8% at 86.11. All right, so that's for West Texas crude oil, still maintaining our intraday bullish bias in any minor pullback that may take shape using a tightened short-term pivotal support level at 102.25. All right, so that's for the West Texas oil. Right, and so that sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar on what are the data to take note of for today over here. So in today's data over here is that have came out during the so-called early Asia session before the start of the daily dose, which is China inflation rate and China PPI. So both they are out at 9:30 a.m. Singapore time. So the inflation rate year on year grew higher than expected at 1.3% year on year. Market is expecting 0.8%, and even the PPI decelerated lower than expected, which is pretty much encouraging. Previously, it was negative 1.4%. Market is expecting at negative 1.1%, and it's the deceleration slowed down to negative 0.9% year on year for February, reducing the risk of a deflationary risk spiral in China. So that actually explained to us why the Hang Seng indexes managed to bounce in today's Asia session, still holding above the long-term pivotal support level. And if we head into the European session thereafter, there will be a rather quiet session with the fact that there's an ECB official speaking, ECB Edison at 6:30 p.m. Singapore time. Then as we head into the US session, nothing interesting. This consumer inflation expectation, so this will be a tier 2 survey-based inflation expectation. So this is done by the, if not done by the US Federal Reserve Bank of New York. All right, over here. So do also keep a close eyes watch on this inflationary where is it? Sorry. Okay, why is going back? Okay, pardon me. Let me go back to the calendar again. Okay, I'm not sure why is it showing the previous week. Okay, so let me go back to this week. Okay, so do keep a close watch on this tier 2 consumer inflation expectation. So 3.1%, very high from the 2%, we call it desired target rate that the Fed wants to keep. So it's trading economy is forecasting at 3.1%. So if it goes above 3.1%, that could actually solidify our higher inflation expectation view, which I share you guys in the 10-year and the 5-year US break-even rates last week, and that could solidify the movement in higher oil prices and also potentially continue to see a strengthening of the US dollar in almost all other currency except against the Canada dollar, and a continuation of that risk of episodes in the global stock indices. All right, so that will be at 11 p.m. Singapore time. And bear in mind that for today's US cash market, so the daylight savings now has kind of ended in a way. So the clocks now shift backward on the US side of the story. So the US session, the US cash stock market session will open today much earlier at 9:30 p.m. Singapore time instead of 10:30 p.m. All right, so just bear in mind that the US cash stock market session will open 1 hour earlier today at 9:30 p.m. Singapore time. And before the start of our daily dose tomorrow at 7:30 a.m., we have Westpac consumer confidence data up from Australia. So that could influence the Aussie dollar, the Aussie crosses, and in some form the ASX 200. All right, so that sum up today's much more detailed intraday technical outlook on all the broad-based cross asset classes, which also covers the end of the daily dose, given in a very highly volatile session ahead. So I wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.